Most people imagine becoming a millionaire as something flashy and dramatic. Champagne, luxury cars, big houses, private jets, early retirement, and social media filled with motivational quotes about escaping the system. But real wealth doesn't look like that. It's usually quiet, understated, and far more powerful. Reaching $1 million invested doesn't typically transform someone's lifestyle overnight. On the surface, life may look the same, but internally, everything starts to shift. Stress decreases, dependence on a paycheck weakens, financial mistakes become less threatening, and most importantly, money begins to work in a way most people never experience. It starts generating more wealth without constant effort. At that point, money stops feeling like something you're constantly chasing and starts behaving more like a system that keeps compounding in the background. That transition is more impactful than the million itself. Most people spend years focused entirely on income, how to earn more, get promoted, add another $20,000, or build an extra side hustle. Income is crucial early on. It's the engine that allows you to save, invest, and build discipline. But if you stay consistent, there comes a point where your investments become the real engine. That's when things begin to feel different. After years of steady investing, avoiding lifestyle inflation, and staying patient while others spend freely, your portfolio can suddenly grow by $80,000, $100,000. Sometimes it even reaches $150,000 in a single year. And at that point, something unsettling becomes clear. What used to take you an entire year of active work can now happen in the background, without your direct effort. Your portfolio is effectively doing the same job you once had to grind for. That realization tends to reshape how people think about work and security. Suddenly, the questions change. Why chase marginal raises? Why tolerate constant office politics? Why trade health and time for income that may no longer be essential in the long run? Why treat a job as the sole pillar of stability? This is also why two people with identical salaries can live completely different realities. One earns $300,000 a year, but spends it all: luxury rent, car payments, lifestyle upgrades, and constant financial pressure. If the job disappears, so does their sense of stability. Another person earns less, but steadily builds a $1 million portfolio. Over time, their sense of security comes less from income and more from accumulated assets that continue to grow independently. And the part most people underestimate is this: the hardest challenge isn't reaching the first million, it's staying consistent long enough to get there without quitting emotionally. The early stages feel slow to the point of discouragement. The first $10,000 feels hard-earned. The first $50,000 moves sluggishly. The first $100,000 can feel frustratingly insignificant relative to the effort. Even the early hundreds of thousands may feel underwhelming because the visible progress doesn't yet match the input. You're doing the right things, but it often feels like your wealth is barely moving. That's the stage where most people give up. They stop investing, panic during downturns, chase shortcuts like speculative trends, or start spending to feel successful again, effectively resetting their own progress. But those who stay consistent long enough eventually reach a different phase entirely. Compounding becomes visible. Patience starts producing outsized returns, and gradually, your portfolio begins carrying more of the load than your active income. That's why the first million matters so much. Not because $1 million is enough forever, but because it often signals that the system is finally working. Once that system is in place, growth can accelerate. The second million frequently arrives faster than the first. Stress tends to decrease, and financial flexibility expands. In this framework, I'm going to break down why the $1 million milestone can feel almost automatic in hindsight, why it's so commonly misunderstood, why some people who reach it still aren't truly financially secure, and what matters most if you want to reach it faster than average. If you're new to this topic, I'm Toby. I focus on investing, wealth building, and financial independence. If your goal is to make your money work harder than you do, like and subscribe, and let's get into it. To understand why $1 million can feel automatic in retrospect, you first have to understand why the first million feels so slow and frustrating. Because that's the stage where most people quit. You can save your first $1,000 and feel a real sense of progress, only to realize it barely changes your life in practical terms. Then you reach $10,000 and things start to shift. There's a buffer now. A car repair doesn't break you. An unexpected bill is inconvenient, not catastrophic. Emergencies become manageable rather than destabilizing. That's also why many people describe around $20,000 as a threshold of freedom. It doesn't make you wealthy, but it reduces financial pressure and removes the feeling of constant fragility. At $100,000, the experience becomes psychologically more complex. On paper, it's a major milestone. In reality, life often looks nearly identical. Work continues. Bills still arrive. Full financial independence still feels out of reach. The expectation of a dramatic change doesn't match the lived reality, which leads to frustration for many. By $300,000, compounding begins to feel more tangible. Market fluctuations can produce gains that rival or exceed annual salary. Investment performance starts to show up in a way that's impossible to ignore. At $500,000, scale starts to dominate perception. Average market returns can generate outcomes that previously required years of active income. This is where misunderstanding often appears from the outside. What looks like luck is usually just mathematical scale operating over a larger base. At $1 million, the structure changes again. At a simple 8% annual return, that's roughly $80,000 per year in growth without additional work, side income, or active effort. Some years will be higher, some lower, and some negative. But over time, the pattern becomes clear. The portfolio starts behaving like an additional income stream. At that stage, behavior tends to shift. Small optimization tactics matter less. Status spending becomes less attractive. Protecting capital becomes more important than signaling success. Time, health, and stability start to outweigh consumption because the opportunity cost of distraction becomes more visible when assets are actively compounding in the background. And ironically, this is also where some people undermine their progress. Right before compounding begins to feel undeniable, they finally start earning serious money and immediately upgrade their lifestyle. Bigger house, nicer cars, larger mortgage, private schools they can't comfortably sustain. Lifestyle inflation quietly destroys compounding. The trap is powerful because it feels rational. I worked for this. I deserve it. I can afford it now. But the outcome is often the same. High income with almost no meaningful savings. From the outside, they look wealthy, but the underlying wealth machine never actually forms. This is why so many high earners stay financially stuck for decades. Meanwhile, someone earning less but investing consistently eventually reaches financial independence first. Not because they're more talented or lucky, but because they stayed disciplined long enough for compounding to do its work. Wealth isn't created by income alone. It's created by owning productive assets long enough for compounding to become dominant. Most people quit or derail the process right before that shift happens. That's why the first million feels automatic in hindsight. Not because it was easy, but because the hardest phase, the constant manual effort and delayed gratification, starts to fade as the system takes over. And once that threshold is crossed, the next stage changes everything. Many people assume $1 million is a finish line. In practice, it's more like an entry point into a different relationship with work. Before meaningful wealth, employment is mandatory. The paycheck isn't optional. You need it for rent, insurance, obligations, stability. That dependence forces people to tolerate conditions they normally wouldn't. Poor management, long commutes, office politics, rigid schedules, and chronic stress. For many, that dependency persists for decades, simply because uncertainty feels more dangerous than dissatisfaction. Once a portfolio reaches around $1 million, that pressure begins to loosen. Work doesn't necessarily stop, but it becomes optional in a different sense. You gain leverage, you can refuse bad terms, leave toxic environments, take career risks, negotiate more aggressively, or prioritize health and time over marginal income gains. And that shift changes decision-making at a fundamental level. Fear is what keeps most people stuck. It drives them to stay in jobs they dislike, avoid risk, overwork themselves, and make short-term financial decisions that limit long-term freedom. As financial security grows, that fear gradually weakens, and with it, a large portion of the behavioral constraints that shaped their earlier life. Another major shift happens in how time is valued. Wealthy individuals increasingly prioritize convenience over consumption. They outsource tasks, simplify obligations, and remove friction from daily life, not to signal status, but to protect time and cognitive bandwidth. At that stage, time becomes more constrained than money. Investment behavior also changes significantly. With little capital invested, market volatility feels like existential risk. Drawdowns feel personal and catastrophic. Wealthy investors tend to respond differently during downturns. Instead of pulling out, they often continue investing, and sometimes more aggressively, because they understand that volatility is a feature of markets, not a breakdown of them. Quality assets recover over time, and recessions often compress future returns into cheaper entry points. That difference in behavior creates a widening gap. The average investor reacts emotionally, selling into fear. Wealth builders rely on time horizons and probability, staying exposed when others exit. Over multiple cycles, that discipline compounds into a substantial advantage. At a certain stage, the psychological effect becomes even more interesting. Financial confidence becomes quieter and less performative. Status symbols lose intensity. Luxury branding and visible consumption stop carrying the same weight. This happens because perception shifts. You start recognizing how many outwardly successful lifestyles are heavily leveraged or structurally fragile. The distinction between income and wealth becomes obvious. Income can fund appearances, but only assets sustain freedom. Real wealth is rarely visible. It shows up as reduced stress, increased flexibility, and the ability to choose how time is spent. It's optionality, not display. And that's why many people reaching $1 million experience something unexpected. They anticipate consumption, but what they actually gain is control. And control tends to matter more than luxury. Once someone experiences life without constant financial pressure, the idea of returning to constraint becomes increasingly unacceptable. At that point, the game changes. It's no longer just about accumulating wealth. It becomes about protecting and compounding it. And that's where mistakes can become costly, because the transition from accumulation to preservation is psychologically underestimated. After reaching 7 figures, many people fall into 3 common traps. The first is lifestyle inflation at scale. They upgrade housing, transportation, travel, and social environments all at once. Expenses become structurally higher, not temporarily higher. And when fixed costs rise too far, even a large portfolio can begin to feel restrictive again. And this happens far more often than people expect. Someone reaches $1 million and then builds a lifestyle that requires $300,000 to $400,000 a year to maintain. At that point, they're not financially free. They're just operating under higher fixed costs. The pressure hasn't disappeared, it has simply been upgraded. That isn't wealth, it's expensive dependence. The second mistake is overconfidence. This is one of the most destructive phases. After building wealth through patience and discipline, people often shift into aggression. They start believing they've figured it out and move into day trading, speculative crypto positions, overheated real estate deals, or risky business ventures. In many cases, they're not improving their strategy. They're abandoning the one that worked. And the irony is brutal. One impulsive decision can erase a decade of disciplined behavior. A large portion of wealth destruction doesn't happen during poverty. It happens after success, when boredom replaces discipline. Stable wealth is usually boring. Fragile wealth is usually exciting. The third mistake is premature slowing down. After reaching $1 million, some people significantly reduce their investment contributions, assuming compounding alone will carry them forward. While compounding is powerful, it is not a substitute for continued input. Ongoing contributions still meaningfully accelerate the trajectory, especially when combined with an already large base and established habits. This is why the second million often arrives faster than the first. The system is already built. The base is larger. The investor is more experienced. Emotional mistakes become smaller and less frequent. All of that creates acceleration. Wealth building, in that sense, resembles momentum physics. Getting started is the hardest part. It feels like pushing a heavy object uphill, slow, exhausting, and resistant. But once it's moving, maintaining motion requires less relative force. That's the transition point. The first million is the push phase. The second million is often the glide phase. And that's also why experienced investors become highly protective of momentum. They don't just focus on returns. They focus on preserving the system that produces returns. That means maintaining health, consistency, behavioral discipline, and long-term thinking. Because once momentum is lost, rebuilding it is disproportionately difficult. Because they recognize a simple but often overlooked principle. Wealth is far easier to maintain than it is to rebuild. Once it's lost, the recovery process is slow, emotionally draining, and often involves repeating mistakes that were already paid for in time and effort. Then comes another structural shift: legacy thinking. Most people move through three financial phases: survival, stability, and growth. But after substantial wealth accumulation, a fourth phase emerges: continuity. Money is no longer just about personal consumption or even personal freedom. It becomes about impact beyond the individual. At that stage, priorities expand to include children, family systems, long-term security structures, philanthropy, and estate planning. Wealth stops being a short-term personal tool and becomes a long-term intergenerational resource. That changes its psychological weight. For many, this shift is more meaningful than consumption ever was. Because material acquisition eventually saturates, the marginal satisfaction of additional possessions declines sharply. In contrast, the ability to create freedom for others retains emotional value. And the deeper realization that follows is this: most people don't actually pursue luxury in the way they imagine. The symbolic targets, cars, houses, travel, status, are often proxies for something else. What people are really optimizing for is control. Control over time, control over obligations, control over environment and associations, and most importantly, control over whether financial necessity dictates life decisions. That's the real utility of wealth. Not consumption, but optionality. This is why a person with a modest lifestyle and a seven-figure portfolio can experience more psychological freedom than someone earning significantly more while trapped in high fixed costs and obligations. Wealth in practice is often less about visible affluence and more about the absence of constraint. Once that state is experienced, priorities tend to reorganize permanently. External validation loses importance. Status consumption becomes less compelling. Incremental upgrades stop feeling necessary, and decisions increasingly revolve around usefulness rather than appearance. Because they recognize a fundamental principle: recurring expenses reduce future flexibility. Every oversized mortgage, luxury car payment, unnecessary lifestyle upgrade, ego-driven purchase, or long-term financial commitment quietly constrains optionality. And optionality is one of the most valuable outcomes of wealth. Optionality is what allows you to adapt, change careers, start a business, take time off, travel, support family, relocate, prioritize health, or simply choose better environments. It turns life from a sequence of obligations into a set of choices. This is also where many wealthy individuals become noticeably calmer. Not because life becomes problem-free, it doesn't. Markets still decline, businesses still fail, health issues arise, and relationships still face pressure. But financial margin changes how those problems are absorbed. With buffer, setbacks are survivable rather than destabilizing. At a certain point, money also stops being viewed as a source of status or entertainment and becomes a functional tool for protection, opportunity, generosity, and stability. That shift is powerful because it removes emotional distortion from financial decisions. People stop panic selling, stop revenge spending, and stop chasing short-term trends. As a result, their financial behavior becomes more consistent and often more effective. Looking back, the progression becomes clear. The first $10,000 builds basic stability, $20,000 reduces financial fragility, $100,000 changes confidence, $300,000 accelerates momentum, $500,000 introduces scale advantages, $1 million begins to feel automatic as compounding becomes visibly self-sustaining. At that stage, wealth is less about constant effort and more about maintaining a system that already works. That doesn't necessarily mean stopping work. It often means working by choice rather than necessity. And for many people, that is the real endpoint, not early retirement or luxury consumption, but the ability to wake up without financial coercion shaping every decision. That's what wealth ultimately buys: time, autonomy, and reduced constraint. And paradoxically, once money starts working independently, life often becomes less about chasing survival and more about intentionally designing how you want to live.